Hello and welcome to your Monday Futures Market Outlook for March 28th, 2011. This is Patrick Ceresna. For those of you that have not had the opportunity to try out eMoneySource.com's trading room, a 5-day complimentary membership is available. As always, we start off with a weekly chart of the S&P 500 going back 3 decades. When we plot an 80-week moving average on there, it does a very good job to depict the bull and bear market cycles that we've gone through. We remain above that 80-week moving average and with distinctly bullish signals. At this juncture, there's nothing to indicate that this current bull market push has actually ended. We simply are looking at levels where we think that the price action should be contained to, which is around this 1340, 1380 area on the upside, where we're just coming off of. We had already an 8% market correction on the downside. With the market reversing back up, we probably will have retesting of those highs, if not even slightly higher highs along the upside. But overall, we believe that somewhere up here in the bigger picture, particularly when the US dollar starts to rally at some point, we should have a market that does some solid backfilling of this entire rally we've seen for the last couple of years. When we take a closer look at that S&P 500 on the daily charts on the futures contracts, you can see that we made that short-term bottom around the 1250, 1260 area on the downside. We were looking last week for the rally to exceed the 1290, 1300 area for evidence that this was going to come back and retest the previous highs, and we more or less got that. And really at this stage, we technically cannot rule out the possibility that this still is a wedge that could have one more leg of a correction on the downside, but we do not favor this scenario. It's simply an observation that we're making. The most important thing for everyone to pay attention to in the first couple of days of this week is whether or not the bulls can hold support lines or whether the bears can muster up back-to-back sell days. If we came out of the gate, especially catalyst driven, with one big sell day and then no reversal the next day and some further selling, then that may be an indication that something like this may be materializing. But until we have that, the only bias that one could really have is that this market will actually continue to advance back to its previous highs. This is the scenario that we continue to favor unless there was some sort of price action change that would make us immediately get on the defensive. Right now, we favor the scenario of a retest of the 1335, 1345 area at minimum, but at this point we certainly cannot technically rule out the possibility that the S&P even makes a push for 1360 to 1380 on the upside. In order for it to have a very bullish follow through on the upside, it would probably have to be on a further deterioration of the US dollar, which we'll talk about in just one moment. Our key points: we continue to recognize that the intermediate trend remains bullish, even though we're reaching our upside targets for the year. We've been looking actually for a market top to develop somewhere in this 1340 to 1380 area, and if we haven't already seen a top, again, we certainly will not rule out the possibility that the S&P still has one more push higher, but I would think that this next push higher should be traded, and at some point investors need to take their profits on any rallies, as we're not looking for a big robust new bull leg higher. We cannot rule out a topping process which has the market retesting those previous highs numerous times. And even if we do have waves of selling, we do not believe that this is the start of a brand new bear market. So any major selling that occurs, even on multi-month corrections, will probably emerge to being a very good buying opportunity. Next year, I always like to observe the NASDAQ 100, and when we look at that, you can see the retracing move higher. It looks very similar to the S&P 500. We're in a very similar situation. If the whole NASDAQ and the S&P 500 have any back-to-back sell cycles that do any price action damage, we can't rule out the possibility not only a retest of its previous lows, but maybe even a move to 2100. But we don't favor that scenario. The scenario we continue to favor is that even if we have a one-day sell-off that has support levels held, we should have that NASDAQ coming back and retesting its previous highs. We're watching this overhead resistance around this 2350 area today. That's going to be a place that is going to give us some information about whether or not the bulls can follow through on the upside. Next year, I want to take a look at the US dollar index futures, and this is a very important chart to be looking at because the dollar index has tested its previous lows around 75, 50, 76 and has actually bounced. The U.S. dollar weakness has sort of been the crutch in which commodities have continued to advance higher, and subsequently created a base from which the stock market was advancing. Really, at this juncture, we're trying to see whether the U.S. dollar will actually remain in downtrend and actually make even lower lows, as it may head even down to levels down as low as the 74 or lower area. This is going to be crucial, because if for whatever reason we had a short squeeze on the U.S. dollar come in here with a big push above the 77.50 area, and that could quickly put all commodities into a retreat, and subsequently create a market that starts to stall off and top and roll again. And so in order for our bullish scenarios on all commodities and stocks to continue, we'd have to see that the US dollar rallies are more or less contained, and subsequently weakness comes back into that dollar index. If we see any robust breakout here on the dollar, immediately everything has to be reconsidered. Next year, I want to take a look at copper futures, and copper has been channeling this in the sideways kind of flagging formation. Now, theoretically, we can't rule out the possibility that this is a very big head and shoulders topping formation, and if we had any robust selling on copper from this level at the same time as a robust US dollar rally reversal, then that would immediately have a copper retreating in a big way. But really, at this stage, if we have one more or two more legs of weakness in the US dollar index, we can't rule out that copper breaks this blue line on the upside, not only retest the previous highs, but maybe can even gun for 480 to 500 on the upside. We don't want to necessarily be bearish on copper yet. The US dollar has given no indication that the primary downtrend has changed, which means we still have to consider the fact that copper and the other commodities still can advance. Next year, I want to take a look at gold futures, and gold again attempted to break out on the upside, and now is reversed off of those highs. We adjusted that upper focal point to the 1420 to 1440, reflect these little topping formations occurring at this 1440 level. In the bigger picture, there's still not a reversal here in gold, even though we've seen a down day. But any reversal back up off of this level would actually leave the uptrend intact. Again, what would only concern me at this juncture would be a robust US dollar short squeeze on the upside, which causes all commodities to correct. If we saw that, then this could potentially have been a double top that we're seeing on gold, but I will not favor that scenario until we see the currency intermarket relationship confirming it. Next year, I want to take a look at the crude oil futures contracts. We came up for a perfect retest of the previous highs at the 105, 106, and had a good $2 drop off of that high as it consolidated down. This, again, is not bearish yet. That short-term weakness like that could immediately reverse and pop back up, push to new highs, and even gun higher up to the 110, 115 area on the upside. The only scenario in which we could envision a double top in here again would be, again, a US dollar short squeeze on the upside that causes all commodities to sell. So really, this is all a big currency play right now. If we see the crude oil rallying, it should probably be on new waves of US dollar weakness. Finally, I want to take a look at the 30-year Treasury notes, and the Treasury notes tend to rally again on some U.S. dollar strength. And at this stage, with the U.S. dollar having deteriorated again, Treasury bonds have given indication that range-bound bottoming formation that we've been trying to anticipate around this 118 to 122 area may very well be in play. If this is relatively range-bound, we cannot rule out the possibility that Treasury bonds come right to the bottom end of these ranges, find supports, and then roll back up from there. But there's no new robust rally yet in the 30-year Treasury notes, and probably not until the U.S. dollar has finished its sell cycle. That was your Monday Futures Market Outlook. Thank you for joining me.